Do you know why most traders keep losing trades even when their analysis looks correct? It is because their analysis ignores one important thing, which is liquidity, where smart money enters, exits, and takes stops. Until you understand and master liquidity, the market will keep using your correct analysis against you. In this video, you'll learn where liquidity hides and what to focus on to stop getting trapped and lose. My goal is to help a large number of beginners and retail traders make more money in the financial markets through trading. So let's get started. Many beginners struggle to identify liquidity in the market and to know which type of liquidity to focus on before placing a trade. You can revisit my previous video to understand what liquidity is and the different forms it takes. Before placing any trade, the first thing a trader must understand is order flow. Order flow simply tells us the direction of the market and who is in control. When buyers are in control and price is moving upward, the order flow is bullish. When sellers are in control and price is moving downward, the order flow is bearish. Trading becomes easier when we align ourselves with this direction instead of fighting it. The market moves by seeking liquidity. Liquidity exists above highs and below lows. When price moves above a previous high, it takes buy-side liquidity. When price moves below a previous low, it takes sell-side liquidity. These liquidity levels are created at every swing high and swing low on the chart. To understand how liquidity affects price movement, we use two important concepts: break of structure and change of character. A break of structure happens when price takes a liquidity level in the direction of the current trend. If price breaks buy-side liquidity and continues upward, it confirms a bullish order flow. If price breaks sell-side liquidity and continues downward, it confirms a bearish order flow. In simple terms, break of structure tells us that the trend is continuing. A change of character happens when price takes the opposite liquidity level. In a bullish market, if price breaks sell-side liquidity, it signals that the order flow may be changing from bullish to bearish. In a bearish market, if price breaks buy-side liquidity, it signals a possible shift from bearish to bullish. Change of character is an early warning that the market direction might be changing. Now the important question is, which liquidity should we focus on? We always focus on the liquidity that aligns with the current order flow. In a bullish market, we focus on buy-side liquidity as our break of structure target and watch sell-side liquidity as a possible change of character. In a bearish market, we focus on sell-side liquidity as our break of structure target and watch buy-side liquidity as a possible change of character. This keeps us trading with the market, not against it. This brings us to another aspect of liquidity to focus on, which is internal liquidity, also known as the fair value gap. The fair value gap is important because it shows where the market can find fuel. When price moves strongly in one direction, it leaves behind a fair value gap. This gap represents internal liquidity. The market often returns to this area to rebalance before continuing its move. In an uptrend, bullish fair value gaps act as support. Price uses them to gain strength before pushing into buy-side liquidity. In a downtrend, bearish fair value gaps act as resistance and help price push into sell-side liquidity. This is why fair value gaps help us know where to focus. They show the most likely areas where price can react, gather liquidity, and continue the trend. Always keep this in mind during your analysis. When internal range liquidity is no longer respected, it is often the first sign that price may attack the change of character level and possibly reverse. One thing you should always keep in mind when placing a trade is to make sure your stop loss is above external liquidity. Many traders see a price reversal and immediately assume there is a change of character. Most of the time, this is not the case. Price reversals or pullbacks often happen to take internal liquidity. This makes it difficult to identify a real change of character. So, how can a trader identify a true change of character and know when the market has moved from buy-side liquidity to sell-side liquidity? If you want to know, click the follow button and wait for part 3.